Welcome to a special edition community call. Today, this is an AMA. We are joined with Chronos, an up-and-coming protocol on the Arbitrum network. Now, they're similar to a solid leaf fork, but they're doing a few different things, and that's why we're having them in here today to explain the major differences or things that set them apart from your usual run-of-the-mill solid leaf fork. Not that those haven't already been doing well enough, but they've also partnered up with the Byte Masons, or a group of developers that we certainly like here in the DeFi Dojo. So we're going to discuss that and all things solidly. Thank you for joining us, Chronos team. Today we're joined with Unified as well as Satsy. And why don't you two introduce yourself and your protocol?
Since then, I made good money with it, so I just started focusing full time, thinking I could make money if I knew the markets and knew all the stuff that was going on. So I've been doing this, and I've been investing in solidly since its launch when Undercrown launched solidly on Phantom. I remember the good old times, and all of the new forks that have been up and coming. So one thing they had all in common was that there was a lot of mercenary capital trying to get the emissions, farming and dumping them. So we thought it would be, how could this be done different so that there's less mercenary capital in the V33 model and there's sticky liquidity in the DEX. And that's when we got the idea of implementing the reliquary contract from the Byte Masons into our smart contracts and implementing the maturity LPs. We'll get more into it in the AMA. So now if you want to introduce yourself, Unified.
Yeah, hi everybody. I'm Unified. I've been around since about 2020. I'm like a pretty active DeFi investor. I've been doing it pretty much full time since 2020, and I was one of the original investors in the first Solidly. And since then, I've been really fascinated by this model. It seems like it's really powerful and has been kind of making waves on a lot of forks. And for whatever reason, it hadn't really taken a foothold yet on Arbitrum. And so when I got contacted by these guys to kind of help them with this launch, we really spent a long time, like, looking at what has worked and what hasn't amongst the other V33 protocols. And we were very fortunate to have the reliquary release, right around the time that we were planning everything. And so we think that by like adding this new feature that this makes possible, that we've really come up with a solution that's really going to make us stand out from the crowd, and that we think is going to make this hopefully like the premier liquidity layer in V33 DEX on Arbitrum. We're extremely excited about it.
So that is certainly a tall order and a very, very ambitious goal. And I want to get to that quickly. Before we do that, I want to scaffold a bit. I'm pretty sure everyone in here now knows farming, understands yield farming, has used probably Uniswap v2, Sushi protocols, and probably even a handful of Solidly. Now, you've mentioned V33. Can you explain the theory and ideology behind V33 and how it has sort of changed the landscape for farming and what it means to be like an emission token, and the value add of that token?
Yeah, so V33 was developed by Andre Cronje as an attempt to make a more economical and enduring model for protocols to incentivize liquidity. And it was basically an attempt at sort of fixing this situation we gotten into with the quote unquote food farms, where we got ourselves into a little bit of a problem in DeFi where projects that are trying to incentivize liquidity for their token, the only option they really had was through a contract called the Master Chef. And this is like the traditional yield farming that everybody is used to, where you deposit liquidity and you receive LP tokens, and then you use your LP tokens to farm inflationary bullets. And so for projects that are trying to incentivize liquidity to their token, they're forced to really walk the tightrope between, offering incentives and APRs that are high enough that they can attract the liquidity that they need, but not setting them too high that they inflate their token's value away to zero. And the
Right. While you have
problem,
10 other protocols that don't care about inflating their tokens that are also trying to like incentivize even
yeah,
higher.
because if I'm Spring Roll Swap or whatever, and like I don't care about being around longer than 4 months, then I can just set my emissions extraordinarily high. And so, we went through a period a couple of years ago where it was where 100% APRs were seen as really low, and we were seeing APRs get up into like the tens of thousands of percent.
Yep.
And it was one of those things where these projects came out and they burn out, and everybody knew they were going to, but there
Yep.
was still going to be made by keeping it. And so for legitimate projects that had a longer time horizon, this became like a real problem because they couldn't compete with these short time horizon projects. And so what V33 really introduced was by changing the way that the incentives work and by directing the fees to the emission blockers and by providing the emissions to the liquidity providers, it's an attempt to set up this like cooperative strategy in which the most profitable strategy is also the strategy that benefits all participants the most.
So let's walk through that strategy. Right. So with traditional yield farming using MasterChef, you would get these LP tokens. Now there are some PancakeSwap forks. I don't know if you guys remember these, where you could I think Astro, what is it, Astro Dex? Or no, Arbitrum Dex is doing this now. It's like a throwback to the old tokenomics styles. You could take those emissions and then like stake them to get yield in other things. Right. This is one of the ways in which they try to avoid stop pressure. You could stake, your food item, your food token, and they pay you some portion of the fees in BTC or ETH or whatever. So they did have some models that attempted to decentivize sell pressure and incentivize um, buy pressure on the tokens. But walk me through how Solidity models are different.
Okay, so we'll go all the way back to the beginning. Initially, when help launch, the only incentive was the swap fee. And so you could provide liquidity on the deck, and then you would earn a swap fee. And it's still like that to this day. So the next innovation would come with the MasterChef contract, which was developed first for sushi swap. And this was designed specifically to vamp liquidity away from Uniswap. At the time, like decentralized exchanges were really new. And so SushiSwap came online specifically to take liquidity away from Uniswap. And the way that they planned to do this was through this MasterChef contract that allowed you to stake your LP tokens and to earn these inflationary rewards over time. So now for the first time, you'd be getting both the swap fees on the deck and you'd be earning the sushi token. And then to disincentivize people from dumping the sushi token, they developed the X token model, X sushi. So you could then stake your inflationary rewards to earn more inflationary rewards over time. And the thinking there, like you said, was as long as users were staking, they weren't selling the token. And that would help protect the token's price over the long haul. Unfortunately, though, we no longer exist in a vacuum. So what's happened is that like those models were insufficient because even though staking helped protect the token price for longer, there were still people that were selling the token. So over time, the value of the token would break down. When the value of the token broke down, its value as an incentive sort of went away. And so if the only reason you were providing liquidity was to earn this inflationary token, if that token is not worth an amount of money that makes it worth it, then you're no longer incentivized to provide liquidity. So the next sort of upgrade to all of this is what we've seen with Curve. And when Curve introduced the vote escrow model, it was really pretty revolutionary. So this was the same thing as they offered a new incentive, which is called gauge voting, by which when you earned this inflationary token as a reward for providing liquidity, you could then lock your inflationary token for a predetermined amount of time. So this is great for the protocol because with the tokens being completely locked, there's no chance of them being sold. And to convince people to do this, they introduced what are called gauges. And so by locking your token, you earned the right to vote on these gauges, and the gauges are what determines the amount of emissions that flows to the liquidity. So if we kind of think about this in terms of an example, if you're supplying liquidity to, a USDC USD pool, and you're earning the curve tokens as a reward for that, you can then lock your curve tokens, and by doing so, you earn the right to vote on the platform's gauges, and you can direct more incentives to the liquidity pool that you're already in. This has been extremely effective. Curve is like, a great protocol to this day. The only thing that wasn't great about this system was that users, especially smaller users, are a little cautious when it comes to locking tokens for a long duration because DeFi changes really fast and the market changes really fast. And in the event that there is like a catastrophic collapse of the market, users like to be able to exit their positions if they have the potential to do so. And so what the V33 model introduced to this was that by what they did is they represented these locked positions, giving you the same voting power of the gauges. They represented these as a.
Oh, you cut out there. You said they represented these as a, and then your audio cut out.
Oh, sorry, they represented these as year 721 NFT. And so now you had the option, if you wanted to exit your locked position, you could do so by selling this financial NFT over the counter on NFT exchange. And so this kind of solved the problem for all participants in that now people were still incentivized to lock their tokens, but they also had the added benefit of being able to exit that position in the event that they chose to do so. Unfortunately, though, and this model has also been very effective, and this is the model that all V33 forks use, and people seem to love it. However, what we've started to notice over the past year or so is that there is an additional problem with this model that Chronos is going to be the first ones to really make a solid attempt to solve. And the problem with this model is that what started to happen on these V33 dexes is that each epoch, when these votes come in and direct these emissions to the liquidity pools, that changes the APR on those pools every epoch. And so liquidity providers, since they're not locked into anything at all they're doing is they're moving their liquidity and just chasing the highest APR from epoch to epoch. And so this has been great if you're a liquidity provider because you're earning these emissions, you're making money, everybody's happy, except for the protocols, because the protocols who are providing these bribes and trying to get people to vote for their pairs and all this, they're doing this because they need token liquidity. And so while they're getting token liquidity, they're only really getting it in 1 week chunks. And so by implementing the new features that Chronos is implementing, we're providing a clear incentive to make liquidity stickier in these pools. And what that means is that the liquidity will stay stationary in these pools for a longer period of time. And we're not doing that with a lock mechanism. We don't want to shift that risk profile back onto the users. But what we're doing instead is we're modifying behavior through incentives. And so what the reliquary is it's a modified version of the master chef contract. And so when you stake your LP tokens into the reliquary, you're going to earn a boost on the rate of the CHR emissions over time. And the longer you leave your liquidity stationary in a single liquidity pool, the more CHR you're going to earn. This amount is going to increase every week for 6 weeks until you reach full maturity. And at that point, you'll be earning emissions at a 2x boost. And we think that the effect of this is going to be that now liquidity providers are going to have to make a little bit more difficult decision each week as the new votes and the new APRs roll in. They're going to have to ask themselves, okay, do I want to pull my liquidity and move to another pool to chase this high APR? However, by doing so, I'm going to lose the boost that I've earned up until this point. Or do I want to leave my liquidity stationary and continue to accrue my boost and earn more CHR emissions that? And then the other part of this is that these liquidity positions themselves, once they're staked, are also represented as an NFT. So in the event that you're in a liquidity position and you want to take profit from that to move into another liquidity pool, you're going to have the option of selling your liquidity position with the boost intact on the secondary market. You can sell these NFTs on OpenSea. We think that the more mature these NFTs are, meaning the more CHR emissions they're getting, they're probably going to trade at a premium over the prices of the underlying position. And so this is going to create, like, for liquidity providers, a really great option for them to be able to profit and to compound and to switch pools. And then it's also going to create this ultra sticky liquidity. It's possible that, like, once liquidity gets added to a pool, it could conceivably never get removed. Users could just trade the
Continue
NFT.
selling, right? Trade the liquidity,
Yeah.
right?
And so we think that this is going to be something that's going to be very, very, very attractive to protocols. And the protocols will be, therefore, purchasing and locking the CHR token, defending the price, and continuing to add bribes to incentivize this, like, ultra sticky, ultra predictable, ultra long lasting liquidity.
So we went from kindergarten to college pretty quickly there. Let's take a few steps back and make the jump from providing liquidity on a platform that wants the liquidity, that's incentivizing you. Like basic MasterChef model, your sushi, pancake swap, forks, like they want the liquidity for their own platform, to the new model where like Chronos is not looking to accumulate liquidity for itself, for its own DEX, if I'm understanding correctly. Rather, they want other protocols to host their liquidity on your platform. Is this accurate?
Sort of. I mean, we need the liquidity in order for the swaps to happen, of course. But
So,
so
go ahead.
the real thing, so the reason all of this exists, the reason that DeFi exists is really decentralized exchanges.
Oh, sorry. It
It,
looks like we have someone who's not muted. Just muted him. Go ahead.
the reason that all of this exists is that protocols need liquidity for their token. Because if there's sufficient liquidity for the token, it cuts down on volatility. It makes your token available so that people can buy it. Where this is like really, comes into play and is easy to understand is with something like a stable coin. Stable coins benefit greatly from having extremely deep liquidity. It makes them more stable, it makes them more available, and it allows them to grow. And so by having a system in which protocols can incentivize people to provide liquidity through bribes and through this vote mechanism, through these APRs on the pools, right now in the current V33 paradigm, we have this all set up so that it's easy to attract liquidity for tokens, but it's not easy to retain that liquidity.
I
So if
see.
you're a protocol that's trying to get liquidity for your token, what you have to do is you have to continually bribe and spend money and provide incentives that convince the liquidity providers to provide liquidity to your pool. And so what we're changing on this is that'll still go on, but now that for every dollar spent, you'll be retaining more of that liquidity for more than 1 week. Right now, if you spend $100, you incentivize $100 worth of liquidity for 1 week. With this, you'll be able to spend $100 and you'll incentivize liquidity for a far longer period of time.
Right.
And then as you continue to offer those incentives, this will compound and create like an extreme liquidity well for your token.
Incentivizing longer term holding, as well as not disincentivizing retail users who might want a more liquid position by having the NFT uh, if what's the word for it? The NFT, I guess, liquid asset. So in this case, what you've done is you've allowed for protocols to incentivize long-term holding by having this reliquary system that increases yield over time. So this also incentivizes people to hold this long term, but you haven't disincentivized retail users by locking them into a position because you allow them to sell their position on an open market. And the assumption is that the longer a position has been open, the more valuable or more premium it will have because effectively people are paying for theta. They're paying for the time value of that asset.
Correct.
That's pretty cool. I hope it works out because this is certainly something that I haven't seen before, at least not to this level. I guess so. A few questions about the reliquary system, right? You sort of compared the traditional V33 to what you guys are doing, and like with with the traditional, you would have a set amount of emissions, and those emissions would last for a set amount of time, and they wouldn't be. I don't know what the word for it. It's like a logarithmically going up later, or like linearly increasing. Whatever model that is, the reliquary has. They would just be like, this is what you're going to be getting this week, and that would be dilutive as well, and not really incentivizing long-term holding. Now, what is the difference that makes a difference with reliquary? Like, is it not going to be the same inevitable ROI for the user? So the initial yields would look maybe unattractive.
No, so we start everything at a baseline. And so the example I've used before is that, like, imagine that you're working a job and that you're getting, $1 an hour. You should get a better job. But let's say that you're getting $1 an hour, but that your boss gives you a 33-cent per hour raise every week. So on
Right.
week one, you're earning a dollar. On week two, you're earning $1.33. On week three, you're earning $1.66. So let's say that on week three, you're earning $1.66. And then the place across the street opens up and puts up a hiring sign, and they're paying $2 an hour.
Right.
Now, now $2 an hour is more than $1.66. However, you know that if you wait one more week, you're going to get up to $1.99, and after that, you're going to get to $1.32. So if you don't have a progressive increase happening, which is the way the regular MasterChef works, then if you're making $1.66 and the place across the street is paying $2, then it's very clear what you should do. You should go to the place that's paying $2 an hour. But if you're making $1.66 and the place across the street is paying $2 an hour, and you know that you're going to continue to get a raise every week, you need to make a more difficult decision on whether you want to switch jobs. Because even though the place across the street is paying more right now, there's no guarantee that that place is going to continue to pay more over the long term. And so, in many cases, your best bet is to take the hit on the APR in the short term to maintain your raises, and then over time you will outpace the place across the street, even though the place across the street is better in the particular moment. And so by making liquidity providers have to like make this calculation for themselves, we make it a more like, like a little bit more thought goes into it instead of the way it is now. Because the way it is now is just see big number, follow big number.
Right. Yeah, absolutely. So how do you like what is the user interface going to be such that you're informing the user of this tough decision they have to make? Is it going to say something like, or is it going to have some sort of sliding scale where you can see your expected yield after a certain amount of time, given a certain amount of TVL in this particular LP?
Yeah, so we're gonna display the APRs on our pools as a range, probably, the base rate
Sure.
up
Hmm.
to the maximum rate. And then we're looking exactly how we're going to do the NFTs themselves. But because the NFTs themselves, it's just a matter of changing the metadata, we've discussed ways that we might be able to display like what rate of boost or what level of maturity they're at directly on the NFTs. And just to make it kind of as visually appealing and as user friendly as possible.
So
Yeah.
go ahead.
Just to add to that, we've been talking to some marketplaces to create a direct connection and do something together to make this metadata appear in the best way possible that the user and the holder knows what they are holding or what they want to buy. But I think we could also implement this with marketplaces that already exist, like OpenSea. But we've been talking, for example, with the guys from PaintSwap that did a good job with Equalizer, and yep, that's that.
Yeah,
So
because this
good.
is so new, some of this like infrastructure tooling, there might be a little delay on it. But we think that if this is successful, then we're going to create like a clear incentive for this infrastructure to be built. You know, if we have billions of dollars in NFTs being traded, you know, through these MA NFTs, then it seems very likely that some enterprising young developer will want to put together an NFT marketplace to capture some of the fees for these.
Yeah.
Certainly. Now you have this situation where presumably you're also making some of the swap fees from those NFTs. Does that value go back to investors in any meaningful way?
So at this time, we don't have any sort of royalties baked into the MA NFTs.
Okay.
Uh, it's something that we've talked about, but we haven't finalized it. And it may be something that we may in the future develop our own swap marketplace
Sure.
that's, you know, specific to us and be able to provide some revenue streams that way. But at this time, we don't have a plan for that.
So just to clarify, there are two ways in which a user can boost their position. They can either boost their position by locking up, I'm assuming the CHR asset, or they can, I mean, and they can boost their position by having it uh, having it open, I guess, having it staked for a up to 6 weeks. And at 6 weeks, they will maximize that. Now, this is not binary, right? It's not like you need to have the NFT in order to also benefit from reliquary. You will benefit from the reliquary mechanism regardless, but you can also boost that with the NFT. Is that accurate?
Yeah, so the way it works is that the gauges are controlled by the VNFT voters.
Right.
So let's say that the total emissions, the total CHR emissions from the week are going to be 1,000. By voting on those gauges, you control how much of that 1,000 CHR are going to be distributed to each of the pools. So then on top of that, if you're a liquidity provider and somebody votes for the pool you're in, let's say that 100 CHR are going to be distributed out of that total supply of 1,000. 100 are going to go to that pool for that week. So that is not in the hands of the liquidity providers at all. It's only in the hands of the
Right.
voters.
Hmm.
By staking the LPs, though, that determine out of that 100 how many of those CHR go to you directly. And so if you have a more mature position, you will get a higher rate of the CHR that's been sent to that pool for that.
So the potential strategy flow here might be in a theoretical world where this is fully launched and fully liquid, and people understand this protocol. The strategy flow might be, let's go to the NFT marketplace, look for a position that is fully matured. One, see if it's undervalued. Two, see if it's at market value, because those would clearly be preferable than entering the position on your own accord, and then having to wait 6 weeks. And then three, seeing if the math makes sense for you to buy at a premium, based off of this reliquary model of how long it would take you to make up the amount of yield that you're paying the premium for. Does that sound like a pretty common sense sort of way in which to look at investing here?
Yeah,
Not financial advice, but
not financial.
yeah, I like this. This is really cool. So I know we've talked a lot about your system here, and I could probably pick your mind about it quite a bit more. Let's get we have a question from Azaday. Probably pronouncing that entirely wrong, but we have a question from Azaday. Let's get this question out of the way. Then I do have a few more for you. So it says, how does a protocol make money?
So, I mean, the protocols, the team, it means, or I mean, the users make money from the fees that are all of the swap fees that are done in the exchange are given to the BECHR holders, and as for liquidity providers, they'll get emissions of CHR.
So the I think that they're asking like how does the protocol itself for the team? Like how are you guys making money?
Yes, so with the fundraising event of the CHR NFTs, we are getting, I think 40% of the fundraising event will be given for the team and to pay all of the dev work, front end, UI, UX, audits. And also we have 15% of the tokens for the team, and these tokens will be locked mainly on BECHR, and they will be used as first as a way to vote for emissions for the main pairs on the DEX that will be CHR ETH, CHR USDC, and CHR ARP. So this way we incentivize liquidity to get CHR with the pairs that we think most people will use.
Okay, so just to clarify, it looks like Decade might have misunderstood. 40% of the revenue generated from the NFT sale will go to the team, and then 15% of the CHR is locked for the team. That's a 15%. Is that accurate?
Actually, I just took a look. 18% it is.
18%. Okay.
It's a
Yeah,
little bit
so
better.
essentially, as you know, the team are participants in the protocol. A
Correct.
decentralized exchange isn't like a business in the way that a bank is a business. Our benefit comes when the protocol does well in the exact same way that it is for the users.
Yes, I think so. We've talked to a few Solidly teams before, and it seems to be sort of par for the course that the team ends up having large locked positions. They help sort of allocate votes to particular pools from new partners and things like that in order to incentivize liquidity there. They generally, if they're a good team, they're generally not like selling their positions. They're trying to make revenue for the protocol or for the team or even for themselves by participating or interacting with the protocol rather than like dumping their position and forgetting about it.
Yeah, and so for us, I mean, I can't speak for everyone, but for me personally, like my strategy will be as a protocol participant to be voting and earning money through bribes. What we've seen for the token lockers, especially Equalizer has been very successful, and Thena has been very successful, is that the APRs for voters, when the system works properly and is healthy, are really extremely attractive. Between 50 and sometimes over 100% APRs. For locking tokens and voting these emissions. Because when the protocol works well and projects want to incentivize liquidity, they have like a very clear benefit from bribing liquidity. It's very economical for them. And so what that translates into is more competition for people to lock rather than sell their emissions, and provides a great revenue stream for voters. And so if you're doing both, if you're providing liquidity and you're earning the CHR and locking that to vote, you're essentially, by participating in the protocol, you have a chance to build both positions over time and really compound the rate at which you're able to earn, not financial advice.
Right, of course. Okay, so it seems as if we are getting to a point where, oh, I think we have a little bit of feedback here. Who am I getting the feedback from? If your mic is not muted, please mute your mic. I think everyone's muted, so maybe that was just an anomaly. So it looks like we have a few moving pieces here, and I want to talk about the system of yield for the people who are locking or staking. So in a traditional model, the people who get the LP fee revenue are the ones who are staking the LP, who are providing the liquidity, and who are staking the LP. Now, with the Solidly model, the yield from the LP actually goes to the lockers. Is that correct?
That's correct.
Okay, so in this way, it can highly incentivize locking. Now, are there any additional incentives for lockers aside from the LP emissions? Or it's not emissions in this case, the LP swap fees.
Yeah, so V33 dexes also have what's called a bribe marketplace built directly into the UI, and these are permissionless. And so anyone can provide a bribe using whitelisted tokens to help convince the CHR lockers to vote for particular pools. So, for example, if I were a representative of, let's say, Frax Finance, and I wanted to direct more CHR incentives to go to a Frax LP pool, then what I can do is I can post tokens in the Bribe marketplace each epoch that will then that and by doing so, what that says is to all the voters is if you vote to direct incentives to my pool, then you will earn a share of these bribes. And the bribes have turned out to be a really good economical way for projects to incentivize voters to vote in a particular way. And this has become a sizable revenue stream on all V33 dexes to date.
Absolutely. So I was hoping we would get there, where we would get to the bribe model. So in this case, you're saying that not only do lockers benefit from the swap fees of the liquidity pools, and not only do they have the benefit of having a liquid position rather than a locked forever position, because they have composable NFTs, they also have the opportunity to get bribed by protocols who are trying to attract liquidity. And sometimes, if not always, the bribes end up making up the majority of the yield. Is that accurate?
That's accurate. And this is why, it's such a big deal to have this sticky liquidity because by and large, the participants that are supplying these bribes are the protocols themselves. And
Right.
so if we are offering the type of liquidity they want, which is sticky liquidity, then they are going to be more interested in bribing more liquidity to the pools on our decks.
Right. So the theory behind, oh, looks like my mic's a little bit low on the OBS. Hopefully, hopefully you guys can hear me well. So it seems as if the theory behind Chronos is you want to incentivize what you guys are calling sticky liquidity, which means liquidity that stays for, and presumably, I think you guys said 6 weeks was the maturity. So you want to highly incentivize staying around for 6 weeks, which is what is sticky liquidity. And by having that, having this incentive and proving that this incentive is functional, I think that's going to be the real test here. You believe that protocols will then say, okay, well, this is certainly worth bribing because we're not bribing 1 week terms, we're bribing with a much higher return, with a much better return on our investment because we're getting 6 weeks out of our bribe rather than like a 1 week mercenary farmer.
Oh, so really, it's more than 6 weeks. So we think that once liquidity has been provided and staked, and that once these NFTs reach
Sure,
maturity,
right. They
there's
won't
probably
unstake. They'll sell
there
them
probably
because there's a premium.
so we're talking about like once liquidity is provided, it may never be withdrawn.
Right, right. Yeah, yeah.
Just to add, so we think that uh, protocol partners that want to get liquidity, they study what uh, what dexes or what solidity forks they are more efficient on getting more liquidity with the less money spent on bribes. So
Right.
that's
Mhm.
where we might get the advantage of the competition.
Okay, I definitely see the vision here. So the I guess roadblocks are the NFT marketplace. You guys have said that there is a possible future in which you build your own proprietary NFT marketplace. That way you can capture the fee revenue. That makes a lot of sense to me. And that way you can also display the NFTs in a meaningful way so that people can immediately see what they're getting. Am I getting like a 5 week? Am I getting a full boost? What they're buying on launch day, which we should also talk about here in a second here. On launch day, what are people going to expect? So can they just go to OpenSea? And if they do go to OpenSea, will they be able to understand what they're buying, or will it sort of be like gambling and saying maybe this is a good NFT, maybe it's not?
Well,
So the underlying positions will all be displayed on the NFT regardless of what marketplace they're on.
Right.
And so you'll be able to see like what the tokens are, the maturity for those, the value of that in both ETH and dollars. Um, all of that is something that we can bake directly into the NFT's metadata. And so that should all display and make it very clear um, what you're buying, even without a bespoke proprietary marketplace.
So one of the things that's going to be different, so thank you for answering that, by the way. One of the things that's going to be different here, and maybe a little bit difficult for the future expected investors, is that under the model that you're suggesting, it seems as if people will not be able to, if they want to buy these NFTs, they won't be able to determine the size of their investment. They either have to buy a predetermined investment size, right? Like let's say 2 ETH and I don't know what 2 ETH today is going for, $3,500 USDC position, or like they have to find a position that's roughly the size they want and the maturity they want, as opposed to creating a size specifically that they were assuming going into this investment. Is that accurate, or am I missing something?
So if the inability to find an NFT of the exact size that you want is a deterrent, there's nothing stopping you from simply providing liquidity in the amount that you would like and waiting.
Sure.
Where we think the maturity comes in, though, is that there will be people, and again, especially protocols, that will see a value in not having to wait to grow their voting power. And then, the other thing about these NFTs, and this is something that we'll definitely be able to do it by interacting directly with the contract from day one. Um, and we'll be building a UI for that. If that's not ready at launch, it'll be ready soon after. But these NFTs, these MA NFTs that track the liquidity positions, these can also be split and merged. So if you had like a 2 ETH position with a maximum maturity, you will be able to split that into two 1 ETH positions, both at the maximum maturity. You'll also be able to combine NFTs of varying levels of maturity, and then that will adjust the maturity so that it's the average aggregate of both of the NFTs. So these are like the reliquary is pretty well built, and everything is like really composable, and all the functionality is built into it from day one. It's just a matter of developing the user interfaces for these things.
So this sort of brings up one of the other questions that Cryptop is mentioning here. Hey, Cryptop, which is the additional implementations that you guys are doing on top of sort of the original Solidly design. Are those additional smart contracts or that additional code, has that been audited? Is that being audited? And who are the auditors, if so? And if not, what is the reasoning behind not doing it?
Yes, I think I could expand on this. So the additional contracts that have been deployed in our contract from our Solidity forks are the reliquary contracts that come from the Bear Masons. They are a team of, I think, 12 devs, and this contract has been already audited 3 times. And the contracts that we fork have been already audited a lot of times, but still we've been thinking about doing an audit, and we actually have just recently made an announcement that we audited the minting contract with 30. Still, the launch depends on what decision we take with the audit, because now we have 3 possibilities that are since most and well all of the contracts have been already audited, going without like an official audit and create a big bounty program with Immunify. That's something that we've seen other protocols do, like for example Fina Finance. And we talked to the Immunify guys, and they told us like 20% of protocols do the same thing. Or we have 2 other possibilities that are going with 30 for the full audit, but we think that would take a long time because they've been taking like a week for just auditing the minting contract. And the final possibility that we've been talking is going with a competition audit style with Code for Arena. and that's something I think we're really interested because we like the model of having 80 to 100 auditors looking at the
Yep.
code and not only the few ones from the company. And we believe that that model is more efficient. So if we don't do the code for Arena audit, that I think we will do, we'll go with the Immunify bug bounty program that it's
Mhm.
similar, like the competition style, because it will have a lot of auditors
Yeah,
taking a look.
those two models are fantastic. I think even Sherlock now has a similar model to that, where they attempt to effectively crowdsource the audit by highly incentivizing anyone who's participating in that. So cool. Uh, thank you for that answer. So we got 9 minutes left, and people clearly want to know like a timeline, if you could offer one. So I know tomorrow is the NFT launch day. Can you talk a little bit about that, and then what the timeline after that looks like?
Yes, sure. So tomorrow is the launch of the CHR NFTs, the public mint. We've already sold 30% of the NFTs to for a private sale where partners, protocols, or the team of the protocols partners could buy, and some DAOs would buy. Well, community too, if we thought they were uh, good to the protocol and could help us achieve our goal. And the public mint will be the 29th. And as I said, the launch of the DEX plus the airdrop of the token will be done depending on the audits, but we think a week or 10 days following the mint. And about the mint, there's gonna be some phases. If you wanna talk about the phases, Unified.
Yeah,
Yeah, yeah,
so
please.
the whitelist mint is gonna in two phases. So it's gonna start tomorrow at 4 p.m. UTC for any whitelisted members, and then that'll run for 2 hours. And if you just have the regular whitelist, you'll be able to buy one CHR NFT during that round. And then after 2 hours, we'll move on to the second round. You'll have the opportunity then on a first come, first served basis where you'll be able to mint two more. And if there are any left over after 2 hours, we'll go on to a third public round where you'll have the option of minting up to 10 more. And then if there are any left at the termination of the public round, we'll just burn the rest. But we're pretty confident. There's been a lot of interest, and so we think we're probably going to sell out. But if we don't, we'll just burn them, and then everybody will just get more revenue.
Very cool. Okay, so once again, can you explain the value add for holding one of these NFTs?
Yeah.
So
So, oh, do you want to do it, Sensei?
yes. So the value is getting the trading fees from Chronos, the DEX. At first, I think it will start with 20% of the trading fees, and going with the months, it will decay to 10%, and they will also get an airdrop of CHR. 9% of the tokens have been destined for the airdrop for the minters, and they will get, depending of if you're a minter or a staker, a percent of secondary marketplace royalties for the trading of the NFTs.
Okay, so let's go through that again. 20% of trading fees for the first month, and then that'll sort of like decay over time because clearly you don't want to siphon up all the trading fees from the protocol.
Yeah.
A 9% airdrop, and is there like an estimated timeline on that?
About the airdrop, actually, the minters have a better airdrop than the users because we're also doing a big airdrop for users. So mainly protocol partners, the most loyal and active holders of their community will get an airdrop,
Mhm.
depending on the criteria they think it's best. But those users that get the airdrop get it on a 2-year BCHR locked position. But the airdrop for the minters is actually 50% as BCHR and 50% on a 2-month linear vesting starting at the token generation event.
Fantastic. And then the last thing you said, so There was a 20% of the trading fees for the first month that goes down over time. 9% of the CHR as an airdrop, half of that being, I think you said BCHR, and then half of it being linearly vested over a couple of weeks. And then the third part of that was something about the fees generated by swapping the NFTs. Is that accurate?
Yes, the fees generated on secondary sales and OpenSea or the marketplaces that the NFTs are on.
Okay, so fees generated by the secondary sales of the NFTs on the marketplace will actually go back to the NFT holders. And is it a certain percent of that, or is it 100% of that? What percent of those fees will go back?
Yes, so the percent of royalties will be 5%, and then 1% of the royalties will be given to the CHR NFT stakers, and 2% to the CHR NFT minters. The other 2% is going to be for the team.
Okay, so let's just clarify for anyone who's like maybe confused by that. You're not saying that it's 1%, like of 5%, and then 99% goes somewhere else. You're saying that one of those 5%, so 20% of the 5%, will go back to the NFT stakers, and then other percentages will go back to the team or whomever else.
Yes.
Yes.
So 20% of the fees generated by the secondary market of what do they call those, royalty fees. Okay, back to stakers. Cool, and thank you, thank you also, Satsy, for posting that link so that everyone can read that.
Yeah.
Crypto was asking, is there a floor price for the NFTs?
Well, they've been sold at 0.3 Ethereum in the private sale, and for the whitelisted mint, it will be 0.325, and for the public mint, if we don't sold out in the whitelist rounds, it would be 0.35 ETH. So that's like it. It doesn't need to be like the floor. I mean, price could go down after the mint, but that's like the starting point. We are selling them.
Okay. Now you say the price will go down after the mint. Is that by virtue of like an assumption, or just saying like there's a possibility it goes down? When you say that, what do you mean?
No, I said that it is a possibility. It could
Sure.
go down. We don't
Probably
know them.
could go up, but it could go down.
Right, could go up, could go down, could go anywhere. I think if we look at the Athena NFT, that was an interesting. I know we're running out of time here, but the Athena NFT was potentially an interesting case where we could compare how that performed relative to how yours may perform. And anyone who had held Athena NFT, they would know sort of how those did in terms of fee revenue generated.
Yeah, we saw, well, Apollo, that he's from the FINA team, he's one of our advisors. So we
Mhm.
know a lot of what happened with FINA. And what happened at first was they didn't sell out all of the NFTs. And price actually dropped in the beginning because people valued the NFT as a way to just get the airdrop. So it prices went down because they wanted just the tokens. But as you can see now, I think the price has like, I don't know how much percents go up, but like 3x at least
Mhm.
from the floor price. So uh, we don't know how people will react, but as I said, it could go down, it could go up. We never know.
That's right. Yeah. Well, fantastic. Thank you guys for joining. This has been a really informative AMA, not just to talk about your protocol, but also a chance to talk about sort of the evolution of the decentralized exchange in DeFi from the beginning stages with like your Uniswaps, your Sushis, your Pancake swaps, all the way to what you guys are doing now with not only the V33 model, but also the addition of reliquary and composable positions, composable locked positions. So it's really exciting stuff. I wish you guys the best. I'm very excited about your launch. For everyone's knowledge, I am not sponsored by Chronos in any way. I just I'm interested in this development of technology. So again, really appreciate it. And if anyone has any questions, feel free to join the Chronos Discord. Ask the Chronos team. I'm sure they'll be eager to reach out. I will do an announcement later about how the whitelist giveaway will work from our end. So stick around, or not stick around, but look out for an announcement in the Discord relating to that.
Are we not just um sorry, it's hard
Go ahead.
to speak privately. Do you have your own way that you want to distribute the whitelist?
Um, I don't know how anyone else has done it. I mean, I can just do like a Google form and then
I
just
think
take the first 100 addresses.
okay, okay, we could do that. Sure. I mean,
Okay.
what also we did with other AMAs we've done before is just for the people that has been hearing us for this last hour, I think, to just come to our Discord and tell that they come from Defi Dojo, that they fed the AMA, and we'll give whitelist too if you can do that.
Oh yeah,
Yeah,
absolutely.
we can
So
have them take a screenshot and then post the screenshot in general chat on our Discord, and then our mods will give them.
I
Yep.
yeah, okay. So should I take the screenshot or should we have them take the screenshot?
They should take the screenshot and
Okay,
post
so
it in general chat.
everyone listening, take a screen if you're interested in the whitelist, take a screenshot of you in this call and then post that in the Chronos Discord to verify that you were here, and you will get a whitelist spot.
And so just to add on to this, you will be given the Cronian whitelist role and your name will turn blue. After your name turns blue, you need to go and post the wallet address that you plan to mint from in the submit wallet channel. And then your name will turn like light purple. So there's like two steps to this.
Okay, so step one, screenshot. Step two, post in a specific channel. Can you remember what channel that is?
It's in the submit wallet channel, which you'll be able to
Okay.
see after your name turns blue. So here's a rhyme. If your name is blue, you got more to do. If your name is light purple, you're good to go.
I'm not sure the last part of that rhymed. Okay, so name is blue, and then three, submit wallets in submit wallet channel.
Yep.
Okay,
And
cool.
just so you guys know, the launch will be tomorrow, so you have to be fast.
Yeah, hurry
All
up.
right. Now, final question. I think, I know we're over time, but how over allocated is the whitelist?
I
It's
think
not.
What's that?
it's not over allocated. I think all whitelist people will have the possibility to mint.
Okay, perfect. Awesome. Well, thank you again so much for joining, and have a wonderful rest of your day.
Thank you. This was great. Thank you very much.
Uh, oh, oops. No. There we go.